Good morning and welcome to our appointed representative webinar today. Thank you for registering to the event, and we hope that you're all well. A couple of logistical housekeeping highlights. On the right-hand side of your screen, you'll be able to view your panel, and this is where you can ask us questions. Please note that this webinar is recorded and will be distributed to those registered after the event. We do apologize in advance for unexpected interruption and recording this remotely. So there's a certain disruption out of our control. We do hope we'll be able to make it through the call without any. Thanks in advance for your understanding. So we'll move on to the event and what is the changes that the FCA is proposing. But welcome to our panelists today. So we've got David Murray and Jonathan joining us, who both have been involved with AR and Principal over the years and will help us to understand and go through these proposal changes from the FCA. So we'll move into the next slides, please. So today the objective is we will look through the consultation and provide an insight of those changes and provide tips on how you can get ready for the proposal and policy statements that will be issued later in this year. And shorter review of the regulatory host discussion, because the consultation paper includes two sections. One at the end of the discussion of a new regime or proposal, how the FCA will approach regulatory hosting in the future. So we'll move on to next slides. So we'll start by looking at the background and where and what has led to this consultation. We'll look at AR notification and regulatory reporting changes, the due diligence and oversight proposal from the FCA, and regulatory hosting discussion. And we'll be happy to answer any questions at the end. Thank you. So the background of the consultation paper and what brought us here. So before we do that, let's clarify as to what is an AR. So we're all looking at the same thing. So the AR regime, it's quite old. It was established in 1987, and it's a firm or a person who carries a regulated activity on behalf and under the responsibility of an authorized firm, the principal. Always take the ideas and the concept of the AR is the individual or entity that borrows your authorization. To bring it more in light, ARs, appointed representative, are not authorized. So the principal is accountable for all their actions or omissions. It's an agency relationship that is usually and has to be evidenced through agreement, formal agreement. But what led us to here in the FCA has identified in the past is following several weaknesses in the AR and principal oversight that has led to more complaints and customer harm. And we've got big names like Greensill that have been in the press in a recent year. And we've got also more supervisory cases related to ARs where regulatory hosting is involved. David, could you share with us and the audience a bit as to what you've seen that has led or illustrates those data?
Yeah, thanks, Blondine. Yes, I mean the consultation paper does read like ARs are the source of all woe and tragedy when it comes to complaints and compensation. And I won't necessarily get into the data points the FCA are using for that, but certainly my experience is that events or incidents that take place within an AR result in different outcomes than would be the case if it was a directly authorized entity. So one of the cases I worked on as an example of that was a appointed representative of a large financial advice network. The appointed representative went about their business in line with the agreement with the principal. But on the side, they introduced something called a special deposit account, which clients were able to put their money in, and we did receive a suspiciously high interest rate in return. Most of the funds in that special deposit account went to fund the AR's jet set lifestyle. It was a fraud. And when that came to light, because it was an AR, because the principal was able to point to the limitations regarding the business the AR could do, so it wasn't they were not, or did not contract with the AR to take client money in that way, because they were able to point to an annual cycle of compliance monitoring reviews and a few other controls. The AR was essentially able to wash its hands of the issue, and the victims of the fraud were left trying to seek recovery from the individual involved. Obviously, that put them in a materially worse position than had it been a directly authorised firm, when it comes to things like access to PI cover and indeed access to the Financial Services Compensation Scheme. So yeah, setting aside the kind of pure numerical aspects of what the FCA say around the sheer number of complaints and supervisory issues that emerge from ARs, the potential consequences for consumers as a result of those issues are different because they're ARs, and I think that's quite a significant factor in the FCA's thinking. Jonathan, I know you've seen a few issues as well.
Yeah, I guess so. As David said, the FCA is always slightly uncomfortable with principal AR relationships, as just as a concept from our experience. And yes, another case that actually David and I both worked on together. The supervisory team were concerned because there was a regulatory hosting situation where the number of ARs and the breadth of regulated activities that those ARs were undertaking was huge in comparison to the scale and technical expertise of the actual host, the regulated entity. So there was the size of the ARs was completely disproportionate individually and as a group to the size of the host. And what that meant was that the host was unable really to provide effective oversight and monitoring of those ARs, both from a kind of capacity, so they just didn't have the resource to be able to monitor those ARs, but also from a specialism, technical expertise perspective, because just the breadth of activity that those ARs were undertaking meant that the kind of oversight team in the host just wasn't able to kind of provide the expert oversight it needed. And obviously that then meant that the FCA couldn't get comfort that the activities those ARs were undertaking were being effectively monitored.
Yeah, and some of that activity included mini bond sales, which has been a huge pressure point for the regulator, all the inquiries and the like. So it's the FCA definitely felt the pain around ARs. So I guess this is them moving to try and stem that pain.
Yeah.
Thank you. So we had a question as to the difference between principal and non-principal on those graphs. So a non-principal is a regulated firm that does not have appointed representative, and the others are the one with appointed representative. So, and to your point as to the oversight and having sufficient capacity, is a general oversight, but that also will trigger questions on threshold condition compliance for regulated firms. So once we've considered the background, and we also had, supporting this, the FCA had done 2 market reviews in investment and general insurance that led to several findings on witnesses on the 2 points that you've raised: oversight and capacity to oversee appointed representative. So we'll move on to the next slide and start to look at what the proposal is. So the consultation is several material changes. I will move into the next slide, please. So we've got the consultation on the changes, and the end of that consultation is the first week of March. The final rules are expected by the end of H1 this year. And we've got a second section, which is about the discussion paper on regulatory hosting, which will be supported in the future by further consultation. with clearer definition as to what the FCA is expecting to do in respect of regulatory hosting. So we'll start by focusing on the consultation. We could move to the next slide. So the key element of it is notification and regulatory reporting, which are materially changing based on a proposal. So we'll look in the next slides to what they are. We'll start by AR notification, regulatory reporting, and then followed by the due diligence and oversight. So notification and reporting, at the moment, there is a notification requirement when a firm wants to enter into an AR relationship. But depending on your financial services sector, sometimes you can notify after you started your relationship with the appointed representative, and otherwise it has to be prior. Going forward, all sectors within the financial services will have to notify the FCA prior to the relationship starting and being effective. That is a minor change compared to the level of information firms will have to provide. And this information will have to be provided for AR and some of the information from IAR. Excuse me, the level of notification and will be required for all your existing ARs when the new rules come into force. And I think that can be very challenging for firms if you've got a large portfolio, because you might have a relationship for a very long time. So what you will have to notify and disclose when you enter into a new relationship, why you are considering the AR appointment and how that fits within your business model, and considering the customer impact will be fundamental as well. Which regulated activity you will be delegating, or the AR will be undertaking on your behalf. This is not the products they will be dealing with, so it's quite a broad concept of regulated activity. It's a description of non-regulated activity of the AR. The provision of services to retail clients, they really want to understand the potential customer arm with that relationship, so you will have to disclose if retail customers are involved in this. Then if there was a relationship with other principal, and if there's been cancellation, why, and there's new principal arrangement. If the AR is part of a group, secondment to AR, and I'm sure David and Jonathan can give you a bit of insight on that. Estimation of revenue, and that is going to be challenging because it's also something you will have to notify on a yearly basis. As the nature of the financial arrangement, and in that paper, what we see in several instances is the FCA pointing out as to the importance of understanding conflict of interest that can arise with relationship with appointed representative. Just to clarify, an IAR is an introductory appointed representative, so they introduce, but they don't undertake any other activity. And once you've done the initial disclosure, you will have to provide this information within 60 days before it's coming into force for existing AR, from that the new rules coming into force. Then for new AR, 60 calendar days before the new appointment. And you've got also notification of ad hoc notification. So if there's change of names of your appointed representative, regulatory activity is changing as well. And that is 10 days notice before it takes effect. And for regulatory hosting, if you intend to regulatory host, you will have to notify 60 days prior offering that service. So what does this mean, and what challenges do we see? David, so we see, secondment and conflict of interest. What are the challenges for you on this perspective?
Yeah, I mean, the broader context of that list of additional information to provide is that the FCA consider all of those risk factors, and one of the main ones there is secondment from the AR to the principal. So, and this will crop up when we talk about regulatory hosting situations later on, because that's one of the things that we often see in that environment, particularly in the investment sector, where the AR relationship permits certain activities to be done by the AR, but there are limitations on that. So, for instance, an AR can provide an investment advice, but an AR cannot be an investment manager. And one way around that, the principles of an ARs have formulated, is that you second someone from the AR to the principal, and under their "I'm part of the principal now" role, they can be a manager. So they've essentially permit someone from the AR to act as a manager, even though the AR itself couldn't act as a manager. And clearly, the FCA see that as a risk, conflicts of interest oversight in terms of the ability of the principal to oversight the AR in a sort of lines of defence concept that's kind of undermined when arguably the key role is being performed by a secondee of the AR, so someone who's actually a part of the AR. So yeah, that's one of the big risk factors they're obviously very interested in, and they will be seeking information on.
Thank you. Jonathan, what do you think that an other area that could be challenging for organization, or is those new requirements?
I think some of the benefits that some hosting firms use as points of sale really are the ability for ARs to enter the market quickly. So you can come to a host with an idea and be offering those services to clients very quickly from point of contact with the host firm. And I think the 60-day rule now kind of limits the speed of entry to market slightly. And I think that key to ensuring that you meet those requirements is communication with your ARs or potential ARs as they're coming into the business. I think ensuring that 60-day period is no regulated activity is going on before that 60-day period is lapsed, and that I guess the notifications are made as quickly as possible within the process of onboarding new ARs. Albeit you need to be really comfortable that you've done effective due diligence on the ARs before you onboard them, before you make that notification. So I think there is just a word of caution on the speed with which ARs can enter the market following these notification requirements coming into force.
Yeah, one of the other, if you read the consultation paper, it's very much written in the sense that we assume that principals already know this information actually. So it's just a case of parceling up and handing over to the FCA, which I suspect for many principals may not be as straightforward as is envisaged in the consultation paper.
Yeah, and I think that's the key point, David, is especially for larger firms that have quite a fair amount of ARs, is understanding and being able to put that in a process that is easily reportable, and you can pull out information easily, because you might have a relationship and you might have had that documented in a very structured way initially when the relationship was established, and the relationship have evolved over the years. And understanding and how you keep documenting those evolution, and when you will have to do this disclosure when the new regulation come into force, you've got everything to hand. And that is quite an important one. It's also, there's more information to provide, so it takes longer to submit a submission and bring all of this together. So it's for firm to consider that.
Yeah,
and when we look at all of this,
if firms have, with large AR portfolios are concerned that they don't necessarily have all that information to hand, I would start kind of pulling that together now in advance of the rules coming in, because it's still in consultation, but we don't expect this to be removed when it moves into policy. So yeah, I'd start looking to pull that information together as soon as possible.
Yeah, and I fully agree with you on that. It's also understanding which of your counterparty might be more challenging than other to get the information on time, and the relationship you've got with your appointed representative, and consider at an early stage what will you do if you can't get the information that you need to satisfy your regulatory obligation from a reporting perspective and oversight. And how comparing your current existing AR frameworks and how that is going to impact your framework and the workflow or communication between different departments to ensure it's done on time and you've got all the information you need on time. That information is accurate. The FCA pointed out several times in that paper as well that the accuracy of the information, and it's a responsibility for the principal to ensure that the information they rely on is accurate. Excuse me. So we can look at the next slide. We'll look at the reporting, which is changing because at the moment there is no clear reporting requirement for AR unless under Principle 11 if there's relationship problems associated to the AR and things that the regulator would ought to know. So the information provided when you create a new AR, some of it will be populated to the Financial Services Register. And firms at the moment are required to attest on a yearly basis that the information on the register is accurate. Going forward, the firms will also have to attest that all information associated to the appointed representative is accurate in the Financial Services Register. So it's a bit of work, and there's elements about regulated activity which will be published on the Financial Services Register. So it's understanding how you'll be kept informed of any change of regulated activity scope for ARs, because it's very often not the same teams that do those type of review and attestation that the business considering broadening registry activities from appointed representative. And that follows, the approach from the FCA from use it or lose it, which was launched last year or at the end of the previous year. Complaints data will have to be provided for each AR on an annual basis within 30 days of the end of the reporting period, and that is a principal reporting period, so it might differ from your appointed representative reporting period. Communication, coming back to Jonathan's point, is really important. That brings other challenges as well from a reporting and understanding. Do you monitor and log when complaints are about an AR or when an AR is involved in that complaint process? But another aspect also, because you are going to provide data per appointed representative, is for your complaint teams to understand the root cause of a complaint, and is that root cause attributable to the appointed representative? So you don't allocate complaints to appointed representative that are not at the origin of the complaint. Some AR only take part in a part of the full services provision. We'll have to provide information on AR and IAR regarding revenue on an annual basis. Again, we've got the same point to the reporting period that might be different. And those is regulated revenue for AR and IAR, but for ARs, you will also have to provide non-regulated revenue. So it's understanding as well and defining and helping your appointed representative to understand the difference between regulated and non-regulated revenue, so they provide you accurate information in time. And there is Principle 11 disclosure remain. So David and Jonathan, what do you think firms should go about and do, and what challenges they could face on these?
I think it's all about the quality of the data flow from ARs to principal firms, and I think not in all cases, but quite often the standards, the rigor applied to collecting data within the ARs is not necessarily in line with what principal firms need for their reporting requirements. So I think there is probably an element of preparing existing ARs for a step change in the kind of quality and accuracy of the data that they're reporting to their principal firms, and making clear what those data requirements are before you take a new AR into a principal relationship. David,
yeah, that's definitely an important factor, and it goes hand to hand with your oversight of your AR and understanding the internal controls within the AR. David?
Yeah. I was going to make that link. Is setting the practicalities of getting this data and putting it on a timely basis, frankly, which is going to be challenging in some cases. This is all feeding. I mean, it's clearly feeding into the FCA's understanding of the ARs that you might operate as a principal, and allows them to ask questions and provide challenge back to you. But we're going to come on to it. The other big extension in this consultation paper relates to the monitoring and oversight and assessment aspects of the principal's obligations. It's not only having this data from a regulator so you can pass it on to the regulator, but it's how are you actually going to factor this data into your own assessment mechanisms. Clearly, if the FCA thinks it's important, then you should be thinking it's important as well in terms of how you go about getting comfort on the activities of your AR, the monitoring and the oversight you provide to those ARs. So building those links into the monitoring regime, I think is something to consider.
Yeah, and what we can see as well is that the FCA is establishing an AR team, and they will use all those reports on a market analysis basis to identify area where it could be trend or patterns. And having more information, they're also more likely to ask more questions to principals when they put submission in, but also on an ongoing basis, especially when there's big variation from one return to another. Something to be ready to answer, as we see for normal reporting on other topics. So we'll look at now what are the changes, to David's point, on due diligence and oversight and what the FCA is looking at and focusing on. So they are promoting 5 new requirements. So we've got the customer harm impact assessment, annual compliance assessment of each AR, risk-based approach review triggered by material changes of AR, annual self-assessment, excuse me, and termination for lack of principal oversight capacity. So David, can you provide us an insight as to what the FCA is looking at from a customer harm impact assessment?
Yes, and I think I've probably catalogued all of these as the FCA trying to fill the gaps that I think it perceives exist within SUP 12, to extend the guidance, just to clarify what it always meant, probably in its own minds, regarding SUP 12. So customer harm impact assessment, I think definitely falls into the category of things they would probably expect a principal to be doing anyway, and just putting it into the guidance should make it an explicit requirement in that sense. And it's asking firms. I mean, there's various points within the guidance on this, but it's essentially asking firms to understand as principle what the AR's customers are, what the services are going to be, what the potential detriment is going to be, sort of fundamentals of harm analysis. How bad could it be for customers? There's a consider potential vulnerability and vulnerable clients within the services the AR is providing. So it's a fairly comprehensive, but probably for most people on this call, standard assessment to my mind of what customer harm is. It's just it's a new requirement for principals to actually do that in a documented manner in regards to their ARs. And I think for me, one of the big things about that is keeping it updated, maintained. I mean, there's some of the other things on this list. There's a sort of defined cycle of updating and performing, but I think that the customer harm impact assessment is written on the expectation that principals will maintain this and will be able to update it as and when AR's customer base potentially evolves, their product base potentially evolves. So very much a living assessment. And I think that's, again, factoring into the degree of interaction the principal has with the AR, but I think it's going to be challenging to maintain it as a living document rather than a one-off point in time assessment.
Yeah, and it's integrating it as to where the FCA is going as well, with a consumer duty and all those different outcomes, and consider that distribution chain as part of your product oversight and how you look at all of this, and fair value. Jonathan, annual compliance assessments of each
Yeah.
IR and AR.
Yeah, so I guess similarly, there are already requirements for firms to kind of oversee the systems and controls of its ARs, but this new requirement puts into rules an additional, other than the ongoing oversight that you're doing, annual compliance assessment. So this only applies to ARs and not to introducer ARs, but is a formal assessment. There are specific things that it calls out that need to be reviewed, including the financial position of the ARs to ensure it's solvent and can continue. The fitness and propriety of the controllers, directors, or senior leadership of the team in the AR, and the adequacy of the firm's controls and resources. And I guess what this requirement, similarly to what David was describing, requires is that there is a formal written record of that annual review. I think the firms may be carrying out ongoing oversight and monitoring, but the record keeping and the documentation of this annual compliance assessment, I think, needs to be given special attention. You need to make sure that you're comfortable that you're able to evidence that you've completed this assessment.
Thank you, Jonathan. I think it's also because some firm might have taken a risk-based approach to AR oversight and might not review them with the same level of details every year. And that might mean that you need to review all your ARs every year. That brings a question of, have you got sufficient staff and resources to provide that level of oversight? And it's a minimum standard annual. So if you've got very material ARs and you think that they are very high profile, it's also understanding if that needs to be taken and happen more often. And the fit and proper on that, they're really pushing on that understanding, the capacity and capability of the management within the AR to support the activities that they are undertaking on your behalf. The risk-based approach review and material change. So what the FCA is coming about here is ARs can evolve, your relationship with the AR can evolve, they can grow significantly compared to what the initial relationship was. They can become a principal, material changes can occur, and that has to be taken into consideration and trigger reviews and assessing the impact of those changes at the AR on the risk profile and the level of oversight you would expect and on their control framework. So it's having clarity from firm as to what those triggered will be. Some are defined in the consultation paper and some are not. So within the organization, it's understanding what those triggers are and how you are going to have the appropriate escalation level, because in some cases, the board are required to consider those assessments. So David, and we've got a newbie on the block, which is annual self-assessment that needs to be approved by the board.
Yes, everybody loves some documentation, and this is potentially a very significant one, particularly if you have a lot of ARs, because this is so this is traditional regulatory rulemaking, isn't it? Let's make it very clear that the very top of the organisation, the board, or the principal in this case, is responsible for signing off on the AR environment they operate, and this, and the next slide covers, I know, the ongoing monitoring and oversight expectations of the FCA thinks the principal should be undertaking. Essentially, it's a self-assessment. It's a report approved by the board that says this is what we've done to provide oversight to each of our ARs. These are the methodologies and techniques that we've used to ensure tick all the boxes, fit and proper, understanding of risk, understanding of consumer harm, all of the factors we've covered and we're going to cover, that they're all documented in one place and annually approved by the board. And as I say, that's if you like, just a good way of focusing the board's mind on on how they're undertaking their responsibilities as principal. But I think for me, when I saw this, I thought that the scale of reporting that could be involved, just the sheer scale of the document that might be necessary, could be a major overhead in its own right. Will it focus the board? Absolutely. Will it probably require one or more additional board meetings in the calendar in order to be able to go through it properly? Yeah, I suspect so. It'll certainly make it very clear where sort of the buck stops from an oversight point of view. Yeah, that's for sure.
Yeah, and I think it's the same. I mean, we've seen those model and expand quite significantly recently. I mean, the first things that the board had to look at in that remit was more on anti-money laundering regulation years ago with the MLRO reporting, which was looking at and it's confirming your compliance with the requirements, and if there are gaps or weaknesses, is having appropriate action and remediation plan, and also feeding back to the board as to when these and what happened on those and ensuring they're closed on time. But we've seen it as well on product governance, and we see more and more of those self-assessments to board. They're not sent to regulator, but they have to be made available to regulator on request. Jonathan, they want more clarity about termination.
But yeah, again, I think this is a enhancement and clarification of what I guess the FCA would be expecting anyway. Principal firms should have a clear view of what would constitute a breach of the contract and reasons for termination of the AR contract. But this consultation now brings in specific guidance into the rule book around areas where firms may consider that the contract should be terminated. Also requires principal firms to kind of more formally set out what those circumstances may be. We think probably having a documented policy with kind of escalation points is probably a reasonable thing to do, because there needs to be a consistent approach to monitoring ARs and where they are breaching those terms or approaching triggers that would mean they are breaching those terms. A formal governance process needs to be undertaken to kind of assess whether a termination needs to happen. The consultation also talks about where that termination is happening, that principals have a requirement to ensure that those ARs are wound down in an orderly way so that they don't cause harm to the end customers. So whether that is supporting them in becoming self-authorized or in that way, or finding another principal firm that would be willing to take them on as an AR, or winding them down in a solvent way. That's a key new requirement or clarified requirement in this consultation paper.
And it's also because termination is contractual right. So even if the FCA don't expect all arrangement and agreement to be changed by the effective dates of the new rules, consideration should be given as to amending your AR arrangement, written arrangement, to reflect your right to terminate because you don't have capacity to oversee them anymore, because otherwise that could be quite a challenging position to get into, to get out of contract and terminate contract if you are don't have the sufficient capacity to oversee your appointed representative. So now we'll move on to things that are not new, but they are highlighting focus required and guidance. So there's quite a fair amount of guidance already, but they're announcing several areas. And what does this mean really for firms? Well, it's just to bring our attention more as to what the area that firm needs to focus on, and they might have identified lack of focus. So threshold condition, where are we on threshold condition? Well, continuous compliance and going back to the point as to having appropriate resources to oversee your staff, but also understanding what impact it has on your business and the capacity for a regulator to access appointed representative when they need to. Please, David and Jonathan, anything else on social condition? It's an ongoing, well-established requirement.
Not particularly. I mean, I think there's, all of these. One of the more interesting lines within the new consultation for me is the addition, actually, addition to SUP 12 guidance that talks about the principle, I'm not sure quotes it, systems and controls in place which enable them to effectively oversee financial services staff at ARs to a comparable standard as if they were individuals directly employed by the principal and the AR's activities were in-house at the principal. So, clearly, I think all of these need to be read in conjunction with that sort of overarching guidance that the principal, should be arguably as close to the AR's activity as they would be if it was being done in-house, in the office next door, which it is, again, probably through the FCA's sort of statement of what they would expect, obviously, but probably does not reflect, in all honesty, where most principals have been with their ARs to this point. So yeah, moving all of these to the level where you're as comfortable with the AR as you would be if they were an in-house staff member, I think is obviously a significant change to my view.
And for you, Jonathan, which one here just really attract your attention and you think will be challenging?
I think there's two that jump out. One because which is the adequate resources, and that's because firms are going to have to make that assessment themselves. What is adequate oversight, what is adequate resources, capacity to undertake that oversight, and ensuring that, as we talked about in the example earlier, that they've got the breadth of regulatory and risk expertise in the principal firm that allows them to effectively oversee. So that's a particular I think challenge for firms. And the other is conflicts of interest management, because in every engagement I personally have had with the FCA on principal AR relationships, the FCA has always criticised conflicts of interest management kind of at a high general level within the principal firm, and said that they don't consider the conflicts of interest management to be adequate. So I think that will continue to be a focus of FCA supervisory teams when they're visiting AR firms or interacting with AR firms. So it's something that I think principal firms should be focusing on in terms of just making sure that they're comfortable that conflicts of interest management framework, policy, processes are one, that they exist, and two, that they are operating and you can evidence that they operate.
Yeah, and there's a lot of different angles, like the secondary aspect, but it's also in a lot of cases a principal get paid for the services they're providing to the AR, and payment from the AR, and how that create imbalance and dependency onto your entire business model, and the livelihood of the company if there were issues or if that relationship was to cease. But from an AR perspective, I think it's also potentially engaging very early with your principal to understand if they are going to change their approach of your oversight. So you understand early what they would be expecting from you, and you can prepare and ease the timeliness of what you will help them with, and also the impact it will have on your own staff as an AR to support that level of oversight and level of information to be provided, because both parties in that consultation will see impacts on both sides. And from principal, is engaging with the AR because they might reach the point that it's not economically livable to carry on providing those services, especially when you've got appointed representatives that are provision of financial services is not the main area of their business. That's an element as well to consider how this will impact their business. So we looked at that, so now we'll move on to looking at regulatory host and what the FCA is looking at and considering. So regulatory host, it's a regulated firm that will not undertake a regulated activity, but that regulated activity will be taken by appointed representative. So there's two scenarios where the host doesn't undertake any regulated activity, everything is undertaken by ARs, but there are also the scenarios where, you know, they appoint some element of what the authorization or regulated activity is undertaken by an appointed representative, but they might, as a principle, undertake some of the regulated activities they are authorized for. So that is really the type of scenarios of what we are looking at into regulated hosting. So we look at what are the FCA what are they considering on regulatory host, and how they will look at them in the future. So the first option they are considering is prohibiting regulatory hosting. What is your intake on that, David?
Well, I think it's probably the least likely. I mean, partly because, you know, I think it's quite hard to define exactly what a regulatory host is. At what point do you cross the line between being a regulatory host versus being a business that exists in its own right but has some ARs? I think there's a grey area in there. I think clearly it's an option they put on the table at this point, but I see the other measures they discuss, and then we'll cover in a second, as being much more likely than an outright prohibition. I think safe regulatory hosting, even from the FCA's perspective, is possible, but it may well involve one or more of the other options on this page being pursued.
Yes, that will have an impact on innovation in the industry if this will be fully prohibited.
Yeah, I mean the main consultations, the rules consultation that we've already covered. The CBA, the cost benefit analysis, suggests that maybe 10% of ARs will drop out of the market as a result of those new rules. Question mark. But clearly, if you prove it regulatory hosting, then about half of all ARs are gone overnight. So yeah, this would be a neater option.
Yeah.
Yeah, I agree. I don't think the consultation necessarily covers the benefits of regulatory hosting. I think we had a question about the HM Treasury request for evidence, which I think actually does a better job of pulling out some of the benefits. And as Blondie mentioned, you've got that potential for innovation, you know, providing a cost-effective entry to market for some firms who you know, don't have the scale to have their own compliance and risk functions. And you know, we've had issues recently with firms that are trying to become directly authorised. It is a 9 to 12 month timescale now because of the resource constraints at the FCA. So it also provides, you know, a more timely entrant to market for AR firms. So I think, yeah, as David said, that prohibiting regulatory hosting, I don't think would allow the FCA to meet their kind of effective market objectives anyway, because the kind of the benefits of regulatory hosting would be lost, which I think is too great a cost.
Yeah, I mean, we've got the other options that we've seen is, to your point, David, earlier, as to, you know, disproportion of the size of AR and the size of principal and the capacity to oversee it. So this proposal of limiting the numbers of AR per principal, limiting the size of AR. I mean, while this is possible, you know, we know the diversity in a financial services. I mean, financial investment, asset management, general insurance. There are two business models that work very differently. Size and scales are very different. So even the FCA, I mean, I think that it would be very challenging to implement. And even the FCA is acknowledging that and considering that if they were to consider such options, it will take quite a significant transition period to get there. Approving large regulators saying is the same. We are the same. Limiting numbers of AIs, again, to your point, Mr. Johnson, you know, there are principles there that, you know, have a very good management of their AI, and there's several of them. And why should they be limited of the numbers of AI if they do a good job and they know what their AI and the behavior and, you know, delivery by the AIs are appropriate and support properly financial services delivery and good customer outcome. Reducing regulated activity open to AR. David, you already touched points that there are some areas that ARs cannot undertake already. So we might see a bit more restriction on that.
Yeah.
And developing additional specific rules for regulatory hosting. Well, the FCA has not really laid out what they were considering, except they started to put numbers of individual potentially for risk function or compliance units and things like that, which can be quite risky and very costly for organization, and potentially disproportionate. So we might see, again, to your point, as you prohibiting AR as people, regulatory hosting is people pulling out of the market because they can't support that, and their business model is too small to have that level of resourcing. But that is still relatively high level proposal. And the other one is rely on a current proposal amendment. They will get quite a fair amount of information based on the new reporting that is required, the obligation to disclose that you want to enter. I think the most likely things that we might see, which is Ozo's proposal, is the FCA approving regulatory hosting, so having the consent from the FCA to enter regulatory hosting, because the current consultation paper is looking at notifying but not an approval from the regulator. So that's just one step further for them. They will already get that information. Any other element that you consider that would be challenging here and that firms should consider?
Well, my working hypothesis on the main body of the consultation and the rule changes they're talking about there is that principal firms that are in the regulatory hosting business will, if they haven't already, be thinking about the risk profile of their ARs, that the more homogenous of those ARs are, more the least variation in their activities, then the easier they will be to oversight, almost certainly, and the easier it will be for the board or the principal to fulfil their obligations. So I suspect those existing proposed changes will result in regulatory hosts that are more monoline maybe than some are at the moment, which I think changes the profile of regulatory hosting generally, and may end up serving the objectives that the FCA is considering around this slide. So it may become unnecessary to do more. If it is necessary to do more, then yeah, my best guess is it would be in the field of forcing regulatory hosts to be more focused on specific limited range of activities, and raising the bar in terms of them being able to demonstrate that they are capable of providing oversight to ARs of whatever level of scale they're dealing with. So yeah, not the nuclear end of the scale, but sort of an evolution probably of where the existing rule changes I think are going to drive the market.
Jonathan, anything in this proposal or consideration for discussion?
I think we covered off everything I was going to say as well.
Brilliant. So now, I propose that we open the session to the questions. We've received quite a fair amount of them, so thank you very much for all your questions. There was a question on how you do the customer impact assessment if you're not dealing with retail customers. David, do you want to take that one?
Yeah. I mean, and I think there's a related question on when it comes to the board assessing its ARs and making that annual assessment. Is there a risk-based component to that? So yeah, clearly, my working assumption is that the harms analysis you do needs to drive a lot of what happens downstream by way of ongoing monitoring, and it should absolutely influence the level of work that's going into making that annual oversight attestation. So yeah, understanding your ARs and doing that risk assessment is must result in, I think, differences of approach on the part of the principal. So I mean, the obligation to assess consumer harm, to look for consumer harm, is there irrespective of the AR, but the actual harm you're identifying is going to be quite different depending on the AR's activity. And so yes, that answers that. Clearly, whether you call that a risk-based approach or harm-driven assessment is I think is just semantics. It's essentially a risk-based approach by another name.
Thank you, David. So based on the addition on your requirement, do you have heard of any potential for the distribution approach of AR changing, e.g. pulling out of the market? Well, I think we looked at that, and yes, we might see appointed representative pulling out of the market. We might see small, because in principle decide to distribute their product differently because of the cost associated to have to deliver all those new requirements. That I think it is a reality, and from both sides, principal and appointed representatives, there's a risk associated to that. But there's already a lot of requirement on AR oversight, so it's really going to depend as to the approach and size of oversight AR already principles had already in place, and how much of an increase it is for them.
Question here about the position where an AR is an AR with more than one principal, different activities, different principles. I think the question relates to, you can have the same underlying AR getting data reported by more than one principal, which I think is yes. I think there will be duplication. Therefore, I suppose does anything around these changes make that model harder to operate? I think I guess my personal view on that is if you've got a more invasive principle than you had before, and you've got two more invasive principles rather than one more invasive principle, then maybe maybe for the AR in question that would be more challenging, and certainly the potential for them to reach different conclusions, conflicting conclusions would certainly exist. But I suspect that would just have to be dealt with on a case-by-case basis. I don't think there's necessarily anything within the new rules that will make that that kind of dual principle type model go away overnight or anything like that.
I think it's what we might see is, because the reporting period are based on a principal financial year, you might have two principal having an AR with two different principal and having to report in different reporting periods. So that could be a challenge as well for ARs and lead to interesting question from the FCA. So we're reaching at the end of our time, I'm afraid. So thank you very much. And if you've got any questions, do not hesitate to contact David and Jonathan if there's areas that we have not covered or you'd like to know more about. And thank you very much for David and Jonathan for joining us today. We have launched our new 2022 Grant Thornton Financial Services UK Regulatory Handbook. So please do not hesitate to go on our website. There's a link here. And we'll be sharing with all of you the content of this webinar and the slides. Please do not hesitate to share them with your colleagues. And we've got a list of the events that we are organizing in the near future. So in March, we've got things on the benefit of humanizing our digital customer journey. And there's a lot of things on customer journey at the moment, and regulators who are looking at AI and how AI support this. ESG data and how to bring it to life. Consumer duty event as well, which is a reoccurring, and I think we'll see quite a lot on consumer duty in the coming months, being a big topic impacting all financial services. But I'd like to thank you again for joining us, and I wish you to have a very good day. Thank you. Bye.